We're just going to give it a couple of minutes here to let everybody trickle in. I see a whole bunch of people joining. So give it just a couple of minutes. We'll get started. Again, if you're just joining, good afternoon. We're going to give it just a couple minutes. I know there's still a handful of folks we're waiting on here. All right, seems to have hit the stead. I've got 201, so we'll go ahead and get going. Welcome, everybody. I want to thank you for joining us this afternoon. I'm John Reeks with Old National Wealth Advisors. As always, joined by my colleagues Dave Hatton and George Yost, as well as Heather and Michelle, and a couple of our partners here I will introduce here shortly. We'll be your hosts for today. For those of you that might be joining us for the first time, we tend to do these webinars several times a year, just different topics of interest, things like Medicare, Social Security, this one being taxes. So please be on the lookout for invitations for these. And just one thing I would also mention, you do not have to be a client of ours to join. So feel free on any of these to go ahead and pass along to family members, friends, or anybody that you might think could benefit. Additionally, if there's a topic that you're interested in that you don't see on a regular basis, please feel free to let us know. We'd be glad to add those for future discussion. Today, we're going to be talking about something that touches every single one of us in some form or another, and that's taxes. Regardless of position in life, where you are, there's some potential tax ramifications to something you're doing. And I would venture to say in many things that you're doing. So we're going to talk about some of that today. Before we get started, just a couple of housekeeping. First, if you'll note that while we're not talking about any investment products today, just remember that any investments that Dave or George or I do recommend are not FDIC insured, not guaranteed by the bank, and may lose value. With that, I'm going to introduce our guest speaker for this afternoon, Bill Cass. Bill works with Franklin Templeton, as does Hugh Triplett, who's joining us today as our sponsor. Dave and George and I have worked with Franklin as an investment partner for a number of years. Bill joined Franklin in 2024 from Putnam Investments as the Director of Wealth Planning after serving in that similar role with Putnam for many years. He oversees the development and delivery of financial planning related educational programs and speaks regularly throughout the country to groups of financial professionals and investors on a wide range of planning topics. His expertise spans sustainable retirement income strategies, taxes, estate planning, wealth transfer, college savings, Washington, D.C. policy, and others. We're very excited to have Bill with us here this afternoon. With that, I'd like to welcome Bill Cass. Bill, the floor is yours.
John, thanks. Thanks so much for everybody carving out a little part of their day to hear about taxes, everybody's favorite topic, right? And I guess it's appropriate. We're in sort of the midst of tax season right now, and some of you are still gathering your things together and getting your forms over to your tax professionals. Others may have already finished it and received a refund, or maybe had to write that check. So happy to be with everyone today. And a couple of things before we get started. If you have questions, as John said, feel free to use that Q&A box in the webinar in the Zoom. If you have questions afterwards that you sort of didn't get a chance to ask or didn't think about it, let's say tomorrow you're thinking, oh, geez, I'm thinking about this. I wish I would ask this question. Reach out to your team there. John or George or any of the other David or any of the other advisors there that you're working with, and I'm happy to address a question. They know where to find me, whether it's I can respond to an email or I can get on a quick phone call. So just throwing that out there as well. Today, what the first half we're going to talk about the landscape, and this is sort of post the new tax law, the so-called One Big Beautiful Bill Act, which is the most comprehensive piece of legislation we've seen since the end of 2017. And then secondly, I want to share some ideas around planning. Um, I want you to think about some of the strategies I'm going to cover and think about it in terms of your own personal situation. This is exactly why you work with a financial advisor. I can obviously provide education and I can share some thoughts, but at the end of the day, I don't know your personal situation and what makes the most sense. And everything is so individual. Everything is so personal based on, specific circumstances. So I think it's really important maybe reflect on this a little bit and then have a conversation with your advisor and your team on maybe some things you might be able to modify in your old finances that might lead to a more tax efficient outcome. I think one of the issues with tax planning, just in general, is what I see is that uh, there's a lot of rush. I'd say, people, if they're still working, they get those W-2s, or if they've got investments, they get those 1099 statements and end of January, early February, and then there's a rush to get all those documents. What did I give away to a charity? Did I have mortgage interest? Do I have state and local taxes I might be deducting? And there's this big rush, and then we file our taxes, and then we sort of done, and we just forget about it. And then maybe we revisit taxes in some form or fashion in December when maybe we're thinking about giving money to a charity or we got to take money out of our IRA and that's going to lead to some taxable income. So I would encourage all of you to think about tax planning year round. I know it's not everybody's favorite topic, but again, if you put a plan in place and you're managing your income appropriately and you're maximizing deductions where possible, again, it's going to lead to better outcomes. So the current landscape, we all know that Congress passed this very comprehensive tax law, avoided the expiration of the 2017 tax law. I think one of the biggest takeaways for me is that this law extends at least the prime components, the foundational components, it extends them permanently. So in every tax uh, legislation that I've really studied and I've researched and spoken about going back to the early 2000s under the Bush administration, they've all been temporary. All these big tax laws have been temporary. They have expiration dates. This one has a bunch of temporary stuff in there, but the key piece is the rates, the brackets, the estate and gift tax, the standard deduction. Those are all permanent. So there's no expiration date out there. Now, that doesn't mean they're going to change because permanent tax law is sort of like an oxymoron, right? It's permanent until a future Congress changes it. But I think the absence of an expiration date is really helpful from a planning perspective. It's hard to plan if you don't know what the rules are, right? So I think that's helpful, and obviously I'm going to highlight a lot of the big temporary stuff as well. Um, that being said, I think it's good news that we avoided a big tax increase uh, that would have happened if Congress did nothing. But I think we always have to be thinking about, okay, what's the tax situation now? I think very favorable, both on the income tax side and the state tax side. We're in a favorable tax environment, but what could happen down the road? I'm not talking maybe 1 or 2 years down the road, but 5, 10 years down the road. I mean, we're going to have to deal with solvency issues and Social Security. There will be higher taxes in some form or fashion as a result of that. It is spoiler alert, right? And we just don't know, dealing with the deficits and other types of spending needs the federal government has. We have to be aware of that, and that's going to be a theme. Okay, we're in a good tax environment now. We don't know what's going to happen in the future. There's elements that would suggest there's going to be higher taxes at some point in the future. And is there any way we can hedge that risk? And we'll be talking about that. So look at the new tax law. I'm not going to go through all of these pieces in the interest of time today. We have a nice sort of written piece that covers everything that we can send out to you for sure. That has, it's written in a nice, easy to understand format. Couple things or at least one big thing I want to highlight on this slide is the SALT deduction cap, state and local taxes. This is a big deal in Illinois. It's not a big deal in Texas and Florida where you just don't have those state related income taxes, right? So this notion of, hey, the 2017 law introduces this $10,000 cap. So we don't, the government doesn't care, if your property taxes and your state income taxes are, way over that, you can only deduct 10. So this is a big change, raising it from 10 to $40,000. It's actually a little bit more. It's at 40,400 for 2026, for the tax year that when we're filing next year, right? So that's a big difference. The one from a planning perspective, uh, the one thing that households have to be aware of that some households, if their income is high enough, they're not going to get that jump from the 10 to the 40,000. They're going to, if as their income increases, they're going to start to lose that extra amount. And that really kicks in at, let's call it around $500,000 of income household, whether you're an individual or married couple, doesn't matter. It's for some reason it's not doubled for married couples filing a joint return. It's the same numbers. When you get to around 600,000, you're back to deducting 10. So if you are well below that, you don't have to worry about it. If you're well above that, there's probably not a heck of a lot you can do from a planning perspective to sort of plan for that. But if you're sort of in the middle there, if you're in that ballpark, you just want to be cognizant that if you're adding more income, over that threshold amount, that the phase out amount, which kicks in at around 500,000, you're going to start to lose that deduction. If you're itemizing deductions and if you have a lot of state income taxes, a lot of property taxes you're able to deduct. So that's something you want to be thinking about from a planning perspective. For example, if I was going to deduct $40,000 of state and local taxes on my tax return, I get to the end of the year and I'm right at the cusp of that threshold. Well, I probably wouldn't want to do a Roth conversion because I'm going to be paying income as I convert traditional IRA dollars to a Roth, but then also at the same time I'm going to be losing that valuable deduction. I just don't think the math really works in your favor at that point. So those are some of the things to be aware of. But overall, the drastic increase, really good news for people in Illinois, California, where I was in California last week. There were, obviously folks are really happy about this. New York and New Jersey. That's temporary though. That was for 2025 to the next 5 years. So we don't know what's going to happen, as we get further out. I wouldn't be surprised if they extend it in some form or fashion. So probably need the votes, from especially Republicans in those higher tax states. But all bets are off. We'll wait and see. But that's one of those temporary things. Staying in that theme of temporary tax changes, there's a lot here on this slide. There's extra deductions for seniors, 65 plus. No, it's really, we call it no taxes on tips. It's a deduction. Same for overtime pay, auto loan interest, right? So these items are all temporary. So they apply for the next 4 years. And there's certain phase out limits. Again, we can get you the piece that gets into the detail on that, but just understand at a higher level that there's a lot of folks that are going to be able to take new deductions, especially those seniors. Those seniors, for example, married couples, if they can stay under $150,000 of income, of modified adjusted gross income, not only can they itemize deductions or take the standard deduction, they're going to get an extra $6,000 per person. So the nice thing about these deductions, senior deduction, the tips, overtime pay, auto loan interest, is that you don't have to itemize deductions on your tax return to be able to benefit from them. You can just take the standard deduction, which everyone gets, and then these are additive to that. So I think that gives you a lot more flexibility. And then we're going to have these new Trump accounts rolling out this summer, new savings accounts for minors. I wrote an article about a month on these where I got into a lot of detail on these. At a very high level, you put money in after tax, it grows till you get to be 18, tax deferred. Okay. When the child turns 18 in that year, it becomes a traditional IRA. So the money in there, for all intents and purposes, it's an IRA at that point, which means that if you take money out, you could be subject to a 10% penalty, early withdrawal. There's no exception. And then there's going to be a mix of the money you put in after tax, principal or basis, and then there's going to be probably some earnings. So those earnings would be taxable, right, and subject to a potential penalty. So, something to think about. I think the main thing I've been telling folks as I travel around the country is, yeah, it's always good to have an extra savings account. And if you have a newborn born 2025 through 2028, the government's going to give you $1,000 free to fund one of these. So it's free money. I would take that. Do I want to put more money in there? Well, if I'm saving specifically for a higher education or even just education, right? I would still use a 529 plan. Much better tax benefits. Money still goes in after tax, but when it comes out for qualified education expenses, it's tax free. So better tax. If you know it's earmarked for college or for K through 12 tuition expenses, then that is, the 529 would generally be a better bet. Some changes to charitable contributions. This kicks in this year. So good news for folks that are just taking a standard deduction. Starting in 2026, if you're giving some cash away, you're writing checks to a charity, just a regular public charity, you're going to get a deduction. If up to $1,000 as an individual, 2,000 for a couple. So that's good news. On the other side, if you are writing, if you are a higher income and giving more away to a charity, you're going to have a reduction in how much you can deduct when you when you write a check or you donate a stock to a charity or put money in a donor advised fund. There's going to be a little bit of a reduction in the deduction. It's going to be based on your adjusted gross income. So let me give an example. Might kind of highlight this because it gets a little confusing. Say your adjusted gross income is 500,000. In 2025, if you made a $10,000 donation to a charity, your deduction would be $10,000. Pretty straightforward, right? You give away 10, you get a $10,000 deduction. But beginning this year, on this example, your deduction would be $7,500 because there's a reduction of 0.5% of your AGI. So basically, you don't get to deduct anything until you give more than 0.5% of an AGI. Is it a huge hurdle? I wouldn't say it's a huge hurdle, but it's a consideration for sure. So it's something you want to you want to be aware of. For people that are 70 and a half, over 70 and a half, you can avoid this by just giving money out of your IRA. And again, you don't have to itemize deductions. You can give money tax-free out of your IRA if the money goes directly to a qualified charity. It's called qualified charitable distribution. It's a great alternative. And you can give, per person a year. I think the limit for this year is around $111,000. So it's a big number, and it can include your required minimum distribution. You got to get that required minimum distribution anyways. Maybe you don't really need the funds for your living expenses, and you want to give charity away at the same time. Then just use a qualified charitable distribution, have it sent directly to a charity, no taxes, and you're avoiding that RMD for all intents and purposes, or at least you're avoiding the taxes on it. And then lastly, the estate tax. So this is a big positive. This isn't going to affect a lot of people, but what this new law does is everybody has a lifetime exclusion amount for gifts, federal gifts, and the federal state tax. Okay, that lifetime number was increased and made permanent. In 2026, this year, that's $15 million. So as a couple, both spouses would have $15 million. So basically, that sort of sets a bar, right? So as my wife and I have my 15, she has her 15. So we really don't have to worry about federal gift or state taxes unless our net worth or we're giving more than 30 million as a couple. It's a big number. There's a lot of different problems people can have. If you have a federal estate tax problem, that's a good problem to have because it means you have your high net worth. You would call it ultra high net worth at that point. So a lot of people don't have to worry about that. But for wealthy families or others, maybe someone sold a business and there's been some big windfall like that. This is good news. And again, this is permanent. There's no expiration date. Obviously, future Congress could always change that. But just not a lot of people have to worry about the federal estate tax. All right, so the last bit of our conversation today, and again, I'm happy to stick around for questions, is what are some of the planning strategies we're talking about? Okay, and I'll click through some of these. So one of where I'll start is I already mentioned this, but let me go back to this. I mentioned the phase out of the state and local tax deduction. Okay, remember, last year you could only deduct $10,000 of state and local taxes. Heck, For a lot of people, your property taxes are going to be north of 10,000 without even getting into state income tax, right? So you used to be able to deduct 10. Now you can do up to 40. Okay. By the way, that's 40 as an individual. Again, 40 as a married couple. A little bit of a marriage penalty there. But remember, at $500,000 of adjusted gross income, you start losing that extra deduction. It's actually a little bit different. It starts at I think 505,000, and about 606,000. You're back to deducting 10. So people in that $500,000 to $600,000 range, if they can kind of manage their income, if they're deducting a lot, manage their income to stay closer to 500 than 600, then that might be advantageous from a tax planning perspective, for sure. So that's that phase out really kicks in there. And then just in general, busy slide here, but this is really captures a little bit of the essence of tax planning, right? So here are all the brackets: single and married filing a joint return. Starts at 10% marginal tax bracket, goes all the way up to 37%, right? This is ordinary income. Um, what are we thinking about when we're in the lower brackets? Well, I might want to accelerate my income. Paying 10 or 12 cents on a dollar, that might be a pretty good deal. If I'm in retirement and I have some room left in those brackets, I might want to take a little bit more out of my traditional IRA, right? That's a pretty low cost, right? Deductions aren't really as worth as much to me, if versus when I was in a higher, giving money away to a charity, if I'm itemizing my deductions, I probably wouldn't do if I was a lower bracket anyways, but the deduction just isn't as much. Um, you wouldn't want to take money out of a Roth IRA in those lower brackets. The tax benefit just isn't as great. So in the middle brackets, right, there's things to be aware of. There's something called a 3.8% investment income surtax that applies. $200,000 for individuals, $250,000 of income for couples. You want to be aware of that. That might, your capital gain tax might go up if you got bond interest, dividends. The government's going to come after you for an extra 3.8%. In that area, if you're retired, if your income's a little higher, now you start hitting a threshold where your Medicare Part B premiums you might increase, right? They start at right $200 a month. Some people are paying over $700 a month for Medicare Part B. So you just know that there's some penalties right as your income increases. And then if you're in the highest brackets, what are some of the things to be thinking about? Start with your financial advisor. Obviously you can engage your tax professionals well, but some of these things might apply to you. If I'm in that highest tax brackets, right, I'd want to make sure there are opportunities to do tax loss harvesting, right? Do I have some capital losses I could maybe realize to offset capital gains? Do I want to, if I'm in a higher bracket one year, maybe I give more away to charities that year, increase my deductions. So there's certain things to be doing. Again, what are we thinking about when we're in lower brackets? What are we thinking about when we're in the middle brackets? And what are we thinking about is when we get in those higher brackets? And this isn't everything. This slide isn't meant to be totally inclusive of everything out there, but it's just more getting you thinking about, okay, it all starts with you need to identify what's your marginal income tax bracket. That is the key data point. One of the things that some people, especially seniors with this big deduction, they might be able to realize capital gains without any taxes. So just know that, married couples at around up to about $100,000 of taxable income, the tax rate on capital gains is zero. So with these big deductions, a big standard deduction, if they get this extra senior deduction of $6,000 a piece, they might have some room while they could take some gains off the table and not pay any taxes. So that's an example. A lot of people don't realize that basically, if you're in the lowest two brackets, you're not paying any taxes on long-term capital gains or qualified dividends. Now, if you had a huge qualified dividend or a lot of huge qualified long-term capital gain or huge qualified dividends, that might bring you up beyond that bracket. But if you're within that brackets, those 10 or 12% brackets, that you're not paying any taxes. So if there's an opportunity to take some gains off the table without paying taxes, that's probably a pretty good idea to at least think about. This is a little bit more advanced, but we're seeing some, higher net worth people look at, does it make sense to own property in a separate, what we call a non-grantor trust, a separate trust, and it's technically a non-grantor trust. And I'm not going to do it justice, getting in a lot of depth, but kind of the premise here is that I might get a $40,000 SALT deduction, for my primary residence, property taxes, and state income taxes. I might have more. I might have 70 or $80,000 or more of state and local taxes, but I can only deduct 40, right? But if I own a second home, maybe I can own that home in a trust, a non-grantor trust, which is considered a separate taxpayer. So it's got its own tax ID number. And if that's the case, that trust would have its own $40,000 SALT deduction. So there's a lot of this is just gets very complex, but it's just a consideration. There's a lot of different issues to be aware of. It might be unwieldy to own a separate property in a non-grantor trust. It might not make sense, but at least something that we're seeing, some, kind of higher net worth to ultra high net worth families consider. I talked about tax smart charitable strategies, giving out of the IRA through a qualified charitable distribution, or using a donor advised fund to maybe lump several years worth of gifts in one tax year. So in one year, I might be in a low tax bracket. Well, I might not want to give as much away to a charity that year if I'm not going to, give enough to itemized deductions. And then maybe the next year I'm going to be in a higher tax bracket. I might want to sort of lump several years worth of giving into one tax year, so I can take that deduction if I'm going to itemize deductions on my tax return. And it's fairly easily done with a donor advised fund, because a donor advised fund allows you to make a charitable contribution, right? But then it goes into a professionally managed account, but you don't have to decide right then and there which charity gets the funds. You have some control over that. There's some rules you have to follow, but in general, you don't. If you're giving money away and you don't know, you want the deduction in one tax year and you're not sure where you want to allocate the funds, then use a donor advised fund. Let's lock in the tax benefit that year, and then we can take our time in deciding, where to allocate the funds. So there's gives you a lot of flexibility. I talked a little bit about Roth. I think that a lot of people would benefit from having a mix of traditional retirement assets and assets in a Roth account, um, if possible. Not everybody. It's going to be very, very specific. But I know that for myself, I'm trying to get some money in a Roth so that when I get to retirement, I have some options. So it's almost like, from an investing standpoint, you don't want to put all your eggs in one basket, right? It's the same thing from a tax perspective. If I have a mix of retirement savings, some that if I take the money out, I got to pay the government, traditional IRA assets or retirement assets, and some that if I take the money out, if I follow the rules, it's tax free. That allows me to have some decisions or some options in retirement. Maybe one year I'm in a decent tax situation. If I need some more money, I take it out of my traditional IRA, pay the taxes on it. But in another year, maybe I sold a stock or something, it pushed me up some brackets or something like that, and I needed more money. If I had a Roth, that's when I would tap into it. Or maybe I want to leave it tax free to the kids. Or maybe I want to, look at my kids and say, okay, who's going to be better? Who's going to take care of me in retirement? Then I'm going to give those kids the Roth dollars, and I'm going to give the other ones the traditional IRA dollars. You can go a lot of different ways with this, right, folks? But I think, having that balance, and I'm not saying a 50-50 balance either, but having some exposure to Roth can be helpful. And some people, if they know they're going to be in a much lower bracket in retirement and they absolutely know that, then Roth would make sense. But a lot of people just, I think what we're seeing is some people are getting in retirement, if they've been good savers, they thought they were going to be in a really low tax bracket, and they're like, wow, okay, maybe we're not, because we did so well with a 401k that those required minimum distributions are going to be quite high. So, again, it's all about trying to figure out what your tax bracket is today and what it might look like in the future. And this is what I was saying, right? Getting back to tax diversification, do you have some of your savings in regular taxable accounts? That's not the worst thing in the world. You pay a lower tax rate on long-term capital gains and qualified dividends. Do you have some in traditional retirement? I'm in a 401k plan, have been in one for 35 years. And I like the fact that you get the tax benefit up front. You don't have to pay taxes when it comes out. And then do you have at least some in a tax-free account like a Roth or an HSA or something like that? I think generally, again, this isn't a one size fits all, but generally, if you have some diversification amongst all those three, then that can give you some options in retirement on, maybe how to be a little bit smarter from a tax perspective. And then lastly, a lot of people aren't going to have to worry about the federal estate tax. Most people won't. Most people are, very, very few folks who die, the result is a taxable estate from a federal perspective. In Massachusetts, we have to do some planning because if you have net assets north of $2 million, the Massachusetts is going to get their fair share, and it's going to be up to 16%. So, we have to sort of plan for that. But at the federal level, most people just don't have to worry about it. But I think some people will look at that and say, "Geez, well, I'm good. I don't have to worry about estate planning." But that's only part of it. Estate planning is about a lot more. The day when you designate a beneficiary on an IRA or a 401k, that's estate planning. That's part of the whole mosaic of estate planning. So beneficiary designations. Do you have a will? Do you have a power of attorney if you need one? Do you have a healthcare proxy? These types of things are really, really important. I think one of the things you want to think about as you get older, or if you have older family members, is let's have a plan in place. Let's have documentation in place. God forbid something happens to the matriarch or the patriarch. Where are the accounts? What are the account numbers? What are the passwords? I had to go through this with my father-in-law passing away suddenly many, many years ago. And my mother-in-law didn't know where anything was. And it was like a year more of like a forensic accounting exercise to figure out what was in both their names, what was in just my father-in-law's name, trying to make those changes. The probate system can be timely and costly. So the more that we can be organized and have sort of a roadmap for other family members or for the spouse, so everything is orderly, that is a huge, huge benefit. Hard enough losing a family member and dealing with the grief at the time. And then if you layer over sort of the stress of the financial burdens and the uncertainty, that can just, make a challenging situation, very difficult situation, even worse. So I take everybody puts this off, but really take a hard look at that and say, God forbid, I do this with my wife. I do all the financial stuff. We divide and conquer like most spouses. But I have a roadmap for, God forbid, if something happens, the mortgage, here's who pays it, everything from insurance policies to investment accounts. Everything is all, documented in there. It's going to provide some clarity if, God forbid, something happens to me. So John and David and George, I'll leave it there and I'll see if we have any questions.
And we've got a couple questions in the meantime. And before I get to questions, I want to just make a couple points here, real quick, Bill. So you were talking earlier about capital gains, and if you're in a lower tax bracket, you can maybe take capital gains without any true capital gain tax. There's a gap there where you can escape that. John and I and George, we have some tax planning software that we utilize through a company called Holistiplan, and I would just encourage everybody to reach out to us. Send us your 1040 with schedules. We're happy to put your tax information in and run some different scenarios for you to help look at some of these different techniques that Bill was referring to. The other thing I would just point out is that last slide that you did. The other piece of software that we utilize, and I know a number of our clients on the call today use this as well from us. WealthView is out there, and we highly encourage you to put all that information, those powers of attorney, the trust, the wills, put all that stuff in there in those reports. Something happens to you, your the next of kin, that person who's supposed to be handling your estate, can reach out to us, one call, and we have everything for them and help them establish all that and get that moving. So that said, I would just like to mention those two things. You briefly, well, I don't see any questions coming in here yet, but if anybody does have anything, again, feel free to type it in. Are there any tax planning strategies that would specifically help you alleviate IRMA? You're alluding to that with Medicare.
Yeah, the IRMA, and I go back to uh, you know, David, it's so great that you guys are using Holistic Plan and that doing that type of planning. It's impossible to do without technology because all these thresholds are out there. You get over here and you're in a higher bracket. Over here you got a 3.8% Medicare Certex. Then you have IRMA. Then you have phase under the salt. It's very difficult. So to have technology do that and help
And they're
manage it,
not
I
all the
think
same
that's
number. That would
yeah.
be too easy.
Yeah, I know exactly. That's not how the IRS or the federal government operate. But IRMA, for some people with IRMA, one of the things that you can do is to what extent, um, Roth conversions can help for sure. So if you get into retirement and you're taking money out of Roth, or you've done some Roth conversions, so your traditional IRA balance is a little bit lower and it's not resulting as high as a required minimum distribution, that's an area that could help, right? The one thing about IRMA, some people think, well, okay, maybe what I'll do is I don't have to take money out of my retirement account and I need income, so I'll just throw everything in, I'll double down on municipal bonds, tax-free income, right?
Mm-hmm.
That seems like a great deal, and I love municipal bonds, and for in the right situation. But just to know if they're looking at how much you're going to pay in terms of Medicare Part B premiums, they're going to add back in your municipal bond, your tax exempt interest. So for some people that think that, oh, okay, geez, the light bulb went off, that's a way I can keep under this and keep my Medicare Part B premium down. That's not going to work. So things like Roth conversions will work, and just maybe being aware of your income and keeping it within that range. I don't have the IRMA numbers in front of me, um, but going from
The
200
first
bucks a
brackets.
month to 700, that's a big jump.
Mm-hmm. It is.
You think it's
And
going to get worse too, by the way?
yeah, yeah, I think it will too. As we age, and the Medicare is in worse shape than Social Security. Looking at Roth IRAs, what's your opinion in executing a Roth conversion now, even if your tax bracket's similar with what we project moving forward, if it's similar to be in the future, specifically around potential for higher tax rates in the future?
So it's also going to depend on your legacy motive. So to what extent are you going to be leaving wealth to the next generation? And to what extent might that be include IRA dollars? And some people will have this mindset, right? That if their kids might be in a higher tax bracket, it might be more tax efficient to leave a Roth to them. They got to take it out within 10 years, likely. Like when you
Mm-hmm.
inherit an IRA, unless there's an exception, very few exceptions, the next generation has 10 years to take it out and pay taxes on it if it's traditional. So that's one of the considerations for doing Roth or going back to just maybe being able to reduce your RMD, your future RMD. So what we're seeing, and I think this is at least a consideration, right? For people that have been working their whole lives and maybe they retire, maybe they're retiring early 60s or at 60 or something. You might have a window for a couple of years there where you're in a more moderate or lower tax bracket. And that's a fertile time where you might want to be doing some partial Roth conversions. Again, I don't want to go to Vegas with Roth and say we're putting everything on red or black, right? I look at it as a diversification. I look at my own self. I'm never going to get to 50% in traditional, 50% in Roth without blowing up my tax bill, and I don't want to do that. But can I get to 10% in a Roth, maybe 15 or 20%? That's going to be better than nothing for me, anyways. And it's going to give me more flexibility.
And one other piece of that, and just looking at the whole circle of life here, in your retirement years, odds are one of you is going to pass before the other, and the one that's left behind, your income is not going to necessarily be cut in half. You're not going to lose one income. You're going to have the RMD for both at that point in time. The only thing you really lose, possibly some pension if that's out there, and one Social Security, the smaller of the two Social Securities. So you're not going to cut your income in half, but your tax brackets do get cut in half. So that's
Yeah.
another reason to possibly do that if you're planning on, especially if you have longevity on one side and not so much on the other. So
That's a great point, David. Those going for the joint bracket to the individual brackets, that widow or widower's tax penalty, that's a real thing. The one thing, going back, just one thing on Medicare, remember that you just have to be a little bit careful with Medicare. So you're going to enroll at 65. When you roll at 65 and they're saying, okay, what type of premium is this person going to be paying? Maybe meaning what's their income look like, right? They're going to look at the prior year tax return. So when you get to 63, you got to know that in that time frame, if you did a big Roth conversion, that's going to spike your income, and that might, kick in the IRMA, as you call it, the adjustment. Now, when your income comes back down, your premium will come back down. You're not going to be locked into that higher premium for life, but it's just, if you're thinking about a Roth conversion of really close to 65 in that 2-year time frame, just know what the potential impact is going to be to your Medicare Part B premium potentially.
and you also have the opportunity though to do an SSA 45 to it's a life event and
Appeal.
appeal that.
Yeah.
So you mentioned QCD at age 70 and a half. Can you still do that even though you haven't started the RMD? Which obviously starts at
And
age 73
absolutely,
now.
and there's a good reason why you would want to do that. I QCDs. There's so many people taking the standard deduction, since the 2017 law and going forward, right? And if you're giving money away to a charity, you're not going to itemize. If you paid off you paid off, you don't have any mortgage interest, and give money out of the IRA because someone's got to pay taxes on it anyways. The IRA dollar the traditional IRA dollar is not a great way to pass wealth to the next generation. I'd much rather pass Roth dollar, life insurance proceeds, which are tax free, or even an appreciated stock that gets step up in cost basis at death. So there's a lot more efficient ways to pass wealth than an IRA dollar.
Yeah. You mentioned donor advised funds. Just a quick point here. We do offer those here through LPL. And then lastly, can you clarify on the state of Illinois, how well versed are you on Illinois and their estate tax?
Yeah, I usually, full disclosure, I forgot to look it up before the call.
No worries.
Um,
It's a $4 million threshold here
yeah.
for the state of Illinois. So just anybody who's here in Illinois, if you're looking at that.
That was my guess. My guess was around 4 million or so. It's
Yeah.
like I said, it's 2 million in Massachusetts. And frankly, what we see a lot of people do, David, is they change domicile. And you notice I didn't say residence.
Yes.
There's residence and there's domicile. And I was just having a conversation with one of my family members this past weekend. People think that, oh, okay, I'll just move to Florida and I just got to track my days, which they have a bunch of different apps you can do that with. There's a bunch of apps that track where you are and kind of, to keep records and say, I just need to stay, the one extra day in
6
Florida
months
and I'm good. It's not that simple. You have to establish domicile for tax purposes, which means you have to sever as much or everything from that other state. It sounds
Driver's
facetious.
license and
If you got a dog, get the dog license in Florida and not in Illinois. I mean, everything that you can do, because the law is very gray, and it's intentionally gray, and also the burden of proof in these cases is on the taxpayer, so that the state can just jam you up on this. So
Thank you for bringing that up, Bill, because we just had somebody who did that to a different, not Florida, but to a different state for that same purpose. So thanks for bringing that up. It's that's a good point. So John had one more point he wanted to bring up here real quick. I'm just going to say thank you very much to Heather and Michelle in the background there for all the work they do to put these things together for us. And thank you, thank you, Bill. And John, go ahead. I'll let you finish this out here.
Yeah, actually, just one additional thought around the Illinois estate tax. I think one of the biggest misconceptions is that two actually, is that the 4 million is an exclusion when it actually isn't. It's actually a threshold, meaning if you cross that threshold, now your entire estate, subject to the scale, becomes taxable. So it's not that you get 4 million free. And then the other one, it's also not portable as the federal is. So you can have, sometimes there's the misconception, hey, two members of a couple, I've got 4 million, he's got 4 million, we've got 8 million, we're good. That can be done with the right trust planning, but just another misconception. And one last thing, real quick, just Dave made several points about tax planning, and Bill also alluded to some of kind of the what are your plans for additional inheritance, which accounts are going to go where. We're talking about who's going to get what income do I have at different points. And this is, Dave mentioned wealth view. This is one of the probably the most important things that we do, is help visualize the income sources in the future. So as it stands today, what do you have coming in from a traditional? What do you have in Roth, Social Security, et cetera? Investment income, and then let's map that out, and so we can visualize that through the rest of your life, essentially. So now you can better plan if you know when and where your income's coming from in the tax treatment. So that's all. Thanks.
John, it's the same way in Massachusetts. If you go over 2 million, then back to $1, I think they give you like a $40,000 exclusion. So you're right. It's the same way. It doesn't work that way in the federal side, but at the state side, many of the states are set up that way. So if you're $1 over, it doesn't make any sense to me, but it is, as we say, it is what it is.
Yeah. Well, thank you again, Bill. Thanks, John. Hugh, thank you again for your partnership. And we will look for everyone on the next webinar. Okay. Thank you.